Hey guys, Chisom here. So I was thinking, many of our bills come in on a monthly basis. So why do we have to wait to receive our dividend paychecks quarterly when we can actually receive dividends on a monthly basis as well? Think about it. So here are 4 ETFs that pay their investors dividends on a monthly basis. And the good thing about this is that we are talking about ETFs which are already considered one of the safest ways to invest in the stock market. The first ETF will be the SPHD ETF, which is the Invesco S&P 500 high dividend low volatility ETF. Just as the name implies, this ETF tracks stocks that have high dividends and low volatility. So if as an investor this sounds like something good, then you should keep on watching. SPHD invests 90% of its assets in common stocks of companies listed in the S&P Low Volatility and High Dividend Index. The fund is concentrated on consumer defense and utility. Some of its popular holdings include ExxonMobil, AT&T, and Iron Mountain Inc. In the last 8 years, the dividend price of this ETF has increased by 83% from $0.078 per share in 2013. But it's important to note that their dividend has not been increasing on a year-on-year basis. Sometimes it increases, sometimes it goes down. But overall, in the last 8 years, its dividend has increased significantly, and even the stock price. Yes, in 2012, the share price of this ETF was around $25, but as we speak, it's currently trading at $45 per share. So if you invested $10,000 in this company about 8 years ago, right now the value of your stock will be $18,000, and you would have earned approximately $5,000 in dividends, which sums it all up to about $23,000. And of course, this is without you reinvesting your dividends or adding to your initial investment from 10 years ago. The expense ratio of SPHD is 0.3%, and what that means is that 0.3% of its assets are used towards paying administrative and operating costs, reducing an investor's return by that percentage. What that means is that out of the total return that you should be getting as an investor, 0.3% is taken out of it for the day-to-day running of the fund. It's obvious as to why expense ratio is important to investors, because the lower the expense ratio, the more attractive the ETF is, because it means that more returns will be going to the investors. But we can't say the same thing when the expense ratio is higher. Lastly, the dividend yield of SPHD in the last 12 months is 3.86%. If you don't understand what dividend yield is all about, I already have a video on that. Link will be in the description box or after this video. The next ETF will be DHS, which stands for Wisdom Tree U.S High Dividend Fund. The DHS ETF tracks stocks with high dividends and at least a trading volume of $200 million. If this sounds like something you're looking for, then DHS is one ETF to consider. These funds holdings are very diversified, from real estate to healthcare, utilities, IT, and consumer staples. Some of its top holdings include the Coca-Cola Company, AT&T, and Pfizer. Just like SPHD, it is important to note that the dividends that DHS has been paying over the years hasn't been increasing year on year, but the value of their stocks have actually increased significantly over the past 10 years, starting at a share price of $44 back in 2012 and is currently trading at $84 as we speak. So if you invested $10,000 in DHS in the year 2012, right now the value of your stocks will be around $19.2 thousand, and you'd have earned approximately $4,400 in dividends, which sums everything up to about $23,000. The expense ratio of DHS is 0.3%, and its dividend yield in the past 10 years is 3.77%. The next ETF will be DIA, which is the SPDR Dow Jones Industrial Average ETF Trust. Now, this ETF does not offer the highest yield, but investors who prefer some capital appreciation potential with their income might find this ETF interesting. Also, this ETF started in the year 1998 and is currently one of the oldest ETFs that is still functioning till date. Some of its top holdings include Goldman Sachs and Boeing Co. And just like other ETFs we mentioned, its dividends have not been increasing year on year, but there has been a significant growth in it and also in the price of the stocks. In 2012, it traded at $128, but as we speak right now, it's currently trading at $332.28. So if you invested $10,000 in DIA back in 2012, right now the value of your stock should be around $25.8 thousand, and you'd have also earned a dividend of about $3,000, which sums everything to approximately $30,000. Its expense ratio is 0.16%, and so far is the lowest we've mentioned in this video. The next ETF will be SDIV, which happens to be the Global X SuperDividend ETF. You know why I'm laughing? I'm laughing because some of you will soon drop off, and I'm about to tell you why I would not invest in this particular ETF. While doing my research, I realized that the value of the stocks of this particular ETF has decreased by 50%. Yes, in 2012, this particular ETF traded at about $22 per share, but as we speak, the price is currently at $10 per share. So if you invested $10,000 in SDIV in the year 2012, right now the value of your stocks will be slashed in half, and that's about $5,000. Of course, they have been paying dividends, and with $10,000 initially invested, you would have earned approximately $5,000 in dividends. But when you sum it all up, that really leaves you with the same $10,000 approximately. So your value has really not increased over the past 10 years. If you like how I've analyzed this ETF to decide whether it's a good or bad choice for me, you can watch this video to know how to analyze stocks yourself, so you don't invest in stocks that will lose you money instead of making you money.